All right. So I got a few questions on how to set up your own trades. So I'm going to show you how to set up your own trades on IWM for this week of March 18th through through the end of the week. So if you go to the before and after section in the Discord, you will also see this setup, but right now I'm just going to draw it out. You remember we always want to be reading price from left to right. So what I do is for the weekly, for each week I start on a weekly chart and I see what is price doing on a larger scale because this will tell me where price is potentially going for the week. And so right now we see if we start on the left side, we see these lows get taken out, right? We see price trades down, has consolidation, and then trades down again to break both of these lows right here. So price trades below this low, and price also trades below this low. And so now with price trading below that low, that's a break in structure to the downside. So when price returns there in the future, we're going to be looking for opportunities, right, to take puts. And the reason that we're looking for opportunities to take puts is because there's an order block in the market right here, right? So if you go look at the video where I talk about this is how you should trade, this talks about order blocks a little bit. And so it also talks about this idea that you want to see other orders in the market get flushed before you start looking for any particular bias or entry. And so we see right now, if I draw this line all the way over here, right, this is known as liquidity. Now, this is known as liquidity because you see price trades up, comes down, trades up, comes down, trades up, and comes down. It hits the same spot 3 different times, right? If I draw a gray box in this general area, you see it hits that box 3 different times. And so the more that it keeps on hitting this same area in the market, the weaker that it's going to get. And so in the future, as you see right here, that'll get ran through, right? We know this is the supply zone right here, right? If you go in the before and after section, you'll see what a supply zone is. And it also talks about when to buy calls and when to buy puts. Go look at the when to buy puts video to understand what this setup is. And so we see on the weekly chart, we're tapping into this order block that gives us a downside bias, right? We know that when price is trading in the supply zones, we want to be looking for sells. And so 2 weeks ago, we see price trade up and trade down right here, initiating the possibility for a lower high to be created, right? If I draw if I draw this curve right here, we see that in this downtrend, right, price trades down, it creates a lower high right here, right? That is a lower high because price comes down, it swings up, and then it comes down again. You see price comes down, swings up, it creates another lower high, it trades down, and then we see this right here, this liquidity is created, price runs through it. And now with the formation of this, we're looking for this candle to initiate some type of lower high in the market. And so for this week, what we're going to be doing is we're going to be targeting the low of the previous week, right? We're going to be expecting price to break through here at the minimum. So at 200.21. And potentially price will trade down here. We're going to be expecting this low to get run at the bare minimum. Also this week, which is very important, is the monthly interest rate decision for the economy. I'm not going to get into details about what the interest rate means, but it's an event that makes the market move faster. It increases the volatility of the market. And so you want to be careful. I think the Fed meeting is this Wednesday. So I wouldn't even trade on Wednesday. You don't really want to trade the news as a beginner because that's where it gets risky. And so tomorrow, what I'm expecting is price to take out this low. So I'm going to drop down to an hourly, and I'm going to see where I can enter the market, right? So what do we see? We see these lows get taken out. It's the same exact setup on a bigger time frame, right? We see price trade down. In the first place our price could potentially trade into is this order block right here. We can see price go up and then price come down. That's one scenario. But this scenario, right? These are just scenarios. Don't get too hung up on scenarios. You just want to be reacting to what the market does. But just know that if price comes up here, then you enter puts to the downside. That's a better entry than if you were to enter puts down here. But another possibility is that price opens, or is that when price opens in the morning, you can wait for price to trade up or do whatever it's gonna do, and maybe eventually later in the week, as soon as price crosses this, then we'll be looking for it to come down and take this low out. And so your trade would look like an entry somewhere here, and then you would sell your put right here, right? Or another entry would be you would wait for price to trade up here, right? And then once price does open in the morning, it trades up here. Then you could look for puts to the downside. And then you can even get fancier and you can have your first entry up here. You can add onto your position here and then sell your final position here. Or have opportunities that if it's going to keep going lower, to sell 80% of your position here and then leave maybe two more contracts to run. And by 80% of your position, I mean, let's say maybe you buy 4 puts up here. Or you could even buy 2 puts up here, 2 puts down here. And then after you buy those puts, you could sell 3 of those puts here and let one of them run. And that's just a mini lesson on risk management and managing your trades. If you are gonna buy 4 contracts up here, you always want to set a stop loss. So a stop loss is an area where if price trades above this, then I'm gonna get out. Right? Let's say you enter right here, but then price goes like this. As soon as price crosses that red line, you need to sell your trade. Right? Because your puts, when the market goes against you, your puts are going to lose value rapidly. And so the timing is very important when you trade options. Now, if you enter off a break down here, right? Let's say you enter right there, um, setting your stop gets a little bit more tricky because you know, you would be setting it like maybe up there since this candle would be technically protected, but you see how big this range is, right? And so usually what I will do is I will say the stop loss, once I enter my trade, the stop loss becomes the entry. Oops. Right? So the stop loss will become the entry as my trade goes. If my trade comes against me, soon as price comes and sells and comes up here, I'm going to sell my position. Right? But if you're entering off a break to the downside, right? Let's say in the morning price opens and then it immediately starts going below this candle. You want to be in there quickly. You don't want to be in that trade for too long. Let's say you would drop down to a 15-minute chart, maybe you would target a shorter candle, right? And then you would drop down to a 5-minute, and I'm gonna set this as a target. And then, or maybe you would target this candle, right? So these could all potentially be targets for you to target. And this is potentially what I'm gonna be looking for tomorrow when price opens. So if price opens, right, and it depends on at 8:30 in the morning where price opens. Um, you see these gaps right here? Like for example, price closes in this candle and then opens all the way up here. That's why there's this gap in the market. Now another key tip is that always in the future these gaps are going to get filled. We don't know when, but we know that they always get filled, right? And so my proof for this is also if you look right here, we see a gap up. you see how price comes down and fills that gap, right? If I use the replay function and I go here and you can't see anything, that's how that gap looks, right? That whole area is a gap. And as price goes on, you see it fills that gap. And that's called a market imbalance. And so to see market imbalances, you want to look for gaps. Now I'm going to teach you guys how to identify multiple gaps. So right here, we see a gap down too, but you see price trades all the way back up. It fills that gap and then it goes back down. You see price gaps up right here. In the future, it's filled by this downside move, right? By all of these downside moves. If I draw something like that, you see the gap between these candles gets filled. The gap between these candles got filled by all of this price action, right? And there's also smaller gaps down here. You see this one gets filled. But we see a bigger gap down here that hasn't really got filled. So maybe at some point in the future, price will come fill this gap. We don't know when, once again, but these act as magnets to price. And so you really just want to be looking for areas that price could go to. So yeah, that's pretty much it for this video. If you have any questions, just drop your questions in the chat or just message me personally. And that's kind of the analysis for tomorrow.